Welcome to Breaking News to Trading Moves.
Great to be here.
So we're looking at a pretty specific transaction today, one that's definitely got the market talking.
It has. Clear Channel Outdoor has agreed to be taken private.
And let's get right to the players involved. The buyers are Mubadala Capital and TWG Global.
And they've put a very firm number on the table.
A very firm number indeed. The valuation is sitting at approximately $6.2 billion.
All cash, which is key.
And for shareholders, that breaks down to $2.43 per share.
Now, that number, 243, if you just hear it cold, it may not sound like much.
Right.
But you absolutely have to frame it against where the stock was trading before the announcement.
And that's really the headline here. It's a 71% premium over that pre-deal price.
71%, it's a loud number. In a normal M&A deal, you might see 20, maybe 30%.
Sure.
A number that starts with a 7 that tells you the buyers saw a value that the public market, for whatever reason, was not seeing.
Or maybe just didn't have the patience for.
That's a great way to put it.
For anyone following along, the ticker symbol for Clear Channel Outdoor is CCO.
CCO.
Now, before we really get into the winners and losers, there's a specific clause here we have to talk about. The Go Shop provision.
Yes, this is a critical detail for how the market sees this deal right now.
So what does it mean exactly?
It means even though a deal has been agreed to, Clear Channel has a 45-day window.
Okay.
A window where they can actively, solicit other potentially better offers.
So the store isn't officially closed for business yet.
That's the perfect analogy. They can take this 243 offer and basically shop it around and ask, can anyone beat this?
So our mission today is pretty straightforward. We're going to look at the board, see who benefits from this move, and who might be facing some new headwinds.
It's never just about the company being bought.
Let's start with the most obvious winner then. The target itself, Clear Channel Outdoor. Ticker CCO.
Absolutely the primary winner. If you're a shareholder, you've been holding a stock that was, frankly, treading water. This deal locks in a cash exit at that huge 71% premium.
That's immediate value.
It is, but the why is what's important. Why were Mubadala and TWG willing to pay up like that?
What's the thesis?
The thesis is that out-of-home assets, we call it OOH, are incredibly valuable.
We're talking billboards, bus shelters, airports, that kind of thing.
Exactly. Physical media. In a world where you can block, skip, or just scroll past a digital ad in a second.
You can't really turn off a billboard on the highway.
You can't. It's unskippable, and that creates very durable, predictable cash flow. This deal is a big vote of confidence in that idea.
Okay, so CO shareholders win. But there's another winner here, and it ties right back to that Go Shop window. The merger arbitrage folks.
Ah, the ARBs, yes.
So for a fund like the IQ Merger Arbitrage ETF, that's ticker MNNA, what's the play here?
For them, it's all a math problem. The stock is trading at a certain price, and the deal is set at 243. That creates a spread.
The gap between the two.
Right, but the Go Shop adds another layer. It introduces the possibility of a competing bid.
A higher offer?
Precisely. It creates what traders call optionality. For the next 45 days, there's a chance someone else comes in at, say, $250 or $260 per share.
So a fund like MNA isn't necessarily betting on the future of billboards.
No, they're betting on the mechanics of the deal itself. That Go Shop window is a near-term catalyst that keeps the story alive and keeps attention on the stock.
Okay, let's zoom out a bit to the rest of the industry. The idea of a sympathy play.
Or sector re-rating, it's a classic market reaction.
It's like when one house on the block sells for a record price.
All the neighbors suddenly feel a little bit richer, same idea.
Yeah.
When a buyer pays a 71% premium for CCO, investors look at its direct competitors and start to reevaluate.
And who are the main competitors here?
The big ones are Outfront Media, ticker OUT, and Lamar Advertising, ticker LAMR.
So OUT and LAMR, they get a lift just because their rival got a big offer.
In the immediate term, yes. It resets the valuation bar for the entire sector. The deal sends a message that big, sophisticated private capital wants to own these kinds of assets.
A vote of confidence.
A huge vote of confidence, and that confidence spills over. Plus, if CO goes private, there's one less public company for investors who want exposure to this space.
Scarcity.
Scarcity. It can drive capital into the remaining names like OUT and LAMR.
All right, let's follow the money. A $6.2 billion deal doesn't happen without financing. Who wins there?
The capital providers, for
Oh,
sure. You're looking at firms like Apollo Global Management, ticker APO, and JPMorgan Chase, ticker JPM.
what are their roles?
Well, Apollo's coming in with preferred equity.
And JPMorgan.
They're leading the debt financing syndicate.
So they're winners just because of the fees they're collecting.
The fees are nice, of course, but it's more about the signal it sends. For a while, the market for big leveraged buyouts was pretty tight.
Hard to get the money.
Very hard. The fact that a major bank like JPM and a heavyweight like APO are stepping up to fund a media deal like this, it shows the credit markets are open for business for this sector. They wouldn't lend if they thought the cash flows were unstable.
Okay, that covers the winners. Now let's flip the coin. Who might feel some pressure from Clear Channel going private?
This is where things get interesting. Let's start with their customers, the big agency holding companies.
We're talking about Omnicom Group, ticker OMC.
And Interpublic Group, IPG, yeah.
Why is this a problem for them?
It all comes down to pricing power.
The agencies want to buy ad space for their clients as cheaply as possible.
Exactly. And when you're negotiating with a public company, you know they live and die by quarterly earnings reports.
The 90-day clock is always ticking.
Right. So if you're a big media buyer, you can often squeeze them for a discount at the end of a quarter because you know they need to hit their numbers for Wall Street.
But when the company goes private,
That pressure just vanishes. A private Clear Channel, backed by deep-pocketed owners, doesn't care about a quarterly target.
Right.
They can hold the line on price.
They could just say no.
They can say, this is the price, take it or leave it. That completely changes the negotiating dynamic and could squeeze the agency's margins.
Let's move to another group. You've listed the digital-only platforms as potential losers.
Yeah, the giants. Meta Platforms, ticker META, and Alphabet, ticker GOOGL.
Now, it seems like a stretch to say a billboard company is a threat to Google.
It's not about toppling them. It's about competition at the margins for incremental ad dollars.
A dollar spent on a billboard is a dollar that wasn't spent on a social media ad.
That's the bottom line. A stronger, much better capitalized Clear Channel can now invest heavily in its own data and measurement technology.
To prove its effectiveness.
Right. To prove to a brand that their digital billboard campaign drove actual foot traffic or sales. If they can make that case more effectively, they can start to pull budget away from the purely digital platforms, especially for local and brand awareness campaigns.
So it just creates more competition for those ad budgets.
A tougher competitor, absolutely.
And that leads us to the last group of losers.
Yeah.
The smaller media owners.
The other public players, like iHeartMedia, that's IHRT, and Cumulus Media, CMLS.
Why are they in a tough spot?
Because of that private versus public dynamic we just talked about, a private Clear Channel can play a completely different game.
No quarterly earnings calls.
No quarterly pressure. They can make big, long-term investments in upgrading their billboards to digital screens, even if it means losing money for a year or two to build future value.
A public company can't really do that.
Not easily. If IHRT or CMLS tried to do that, their earnings would drop, and Wall Street would likely punish their stock price. They're fighting with one hand tied behind their backs.
So Clear Channel can invest and accelerate, while its public peers have to stay cautious.
It just raises the competitive intensity across the board.
I want to circle back just for a moment to that go shop provision, that 45-day window.
Sure.
What are we really watching for there? Is another bid likely?
The market just sees it as a possibility. We don't know for sure, but the door's open. It could be another private equity firm that thinks they can run the assets better.
So the story isn't quite finished yet.
No, it's a live situation for the next month and a half. Everyone's watching to see if someone thinks these assets are worth more than $243 a share.
Okay, so just to recap the board, Clear Channel shareholders get a big premium. The arbitrage traders get a live situation to play.
Sector peers like Outfront and Lamar get a valuation bump, and the bankers like Apollo and JPMorgan get to put capital to work.
And on the other side, the ad agencies like Omnicom and Interpublic face tougher negotiations.
Digital platforms like Meta and Google face a better capitalized competitor for ad dollars, and smaller media owners like iHeartMedia face a rival that can invest without the same constraints.
It's a really clear-cut case of how one transaction can change the landscape for so many others.
It really is.
So here's a final thought to leave with everyone. We're seeing a major player go private, specifically to accelerate its digital transformation away from public market pressures.
It's a strategic move.
Does this now force the other public OH companies to consider the same path? If you can't keep up with the investment pace as a public entity, is your only choice to also find a private buyer to stay competitive?
That is the big question for the sector going forward.
It's definitely something to watch.
Absolutely.
Before we sign off, we need to state clearly, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for joining us on Breaking News to Trading Moves.
My pleasure.